Good morning. I'm delighted to be introducing the Spears Wealth Insight Forum today. Few of us would dispute that, as the saying goes, we live in interesting times. This saying is often interpreted as an encouragement, but is actually intended as a curse in China. It is reflective, I feel, of the overwhelming sense of crisis and uncertainty combined with opportunity that the pandemic has provoked in all of us. The global pandemic is changing the way we think, live, and invest. We are all looking at the world through a different lens. One lesson that the pandemic has driven home to me is the unbelievable importance of the statistical information and the science, and how our own behavioral biases can lead us to override or misinterpret seemingly incontrovertible facts. We have also become painfully aware that the statistics are only as good as the data that has been collected, and the old adage, garbage in, garbage out, remains true. So in a world of imperfect information and knowledge, with rapidly changing data and sources that are not always reliable, how can we make good decisions to protect our society, our world, and our wealth? After more than 6 months of lockdown, it looks like coming months will continue to be deeply uncertain and challenging. We're steadily being nudged back to life, a life that looks more open and on the surface, more in tune with pre-COVID rhythms. Schools are returning, we're being encouraged to eat out, to help out. Some offices are reopening, albeit under strange and complex routines. Some of us are cautiously starting to travel and navigate the ever-changing statistics and rules. As we approach a more open tempo of living with newly established habits and coping mechanisms, we might expect to be feeling better. So why do things right now feel so difficult for so many people? The answer is that we still have some grieving to do. My daughter's a junior doctor, and early in lockdown, frontline NHS staff received guidance from the British Psychological Society that you see on the screen in front of you. This identified 4 broad stages for care workers managing the crisis. Reflecting on these, they bear a similar resemblance to Elizabeth Kubler-Ross's grief curve, which describes how people approach, engage with, and process the grief that follows the death of a loved one. I think we are all, without exception, grieving for loved ones, human contact, relationships, health, freedom, travel, businesses, employment, certainty, identity, worldviews. Who among us hasn't lost something in COVID-19? All of this is compounded by a turbulent geopolitical landscape, a relentless stoking of national and international divisions, a long overdue global dialogue around systemic racism, and the stripping away of certainty in many areas of our lives. We're grieving familiarity and stability. We're also grieving the loss of freedom and privacy. Wherever we live, we have all been forced to adapt to and accept previously unthinkable restrictions on freedoms. Estimates suggest that the economic implications of the lockdown on personal movement and business operations is one of the greatest since World War II. As restrictions are eased, the trade-off for physical freedom is likely to be digital freedom and our right to privacy. Surveillance measures are being put in place, which in many countries are becoming the new normal. In China, the government has introduced new and invasive methods, from talking drones to CCTV and location tracking. This kind of technology is not limited to the East. In many countries, it is likely that these short-term emergency measures will become a fixture of life. That is the nature of emergencies. They fast-forward historical processes. Corona, as we know, has accelerated existing trends, some to the good and some to the negative. It has also reversed progress in others. Sadly, one of the trends which has accelerated is economic and social inequalities around the world. The spread of the virus has particularly hurt the working poor. It has hurt the developing countries. The acceleration in technological change has favored the world's citizens who are well educated with access to the internet. The lockdown has reversed many positive trends, and it has widened the gender gap as women worldwide have shouldered the burden of school closures, often working in the most affected areas like retail and hospitality. I attended a wealth management conference last week where a survey was conducted of wealth managers' priorities when it came to assessing investments. And I was surprised to see that societal wellness was at the bottom of the list. I believe it should be much further up at the list of investors' considerations. Coronavirus hit the world at a time of weak levels of international cooperation, there's no denying that, and global tensions, and a time when the UK and the US were pulling out of major trade blocs. The wider trends towards nationalism have been accentuated. Developing countries have been shut out of richer markets, supply chains disrupted, businesses and business models wiped out. It is likely, according to the World Economic Forum, that the pandemic's effects on inequality will be felt for many years to come, unless governments take concerted action and unless investors take concerted action to provide finance and debt relief for low-income countries and help workers adapt to a digital future. Financial markets, on the other hand, seem to be looking across the valley to a much more optimistic future. After March, the US stock market, as represented by the S&P, returned its strongest quarter in over 21 years, despite the US economy suffering its worst ever quarter. The US index performance was narrowly driven by a small handful of technology names, amongst others. Alphabet, Facebook, Apple, Microsoft, and Amazon now account for over 20% of the value of the S&P 500 and have a combined value of almost 8 trillion. They are also trading at 40 times their expected earnings, and this narrow leadership is causing some consternation with investors who are worrying about the sustainability of the rally and the valuations of these companies. And as we saw in September, these companies are reacting quickly then to changes in perception. So just as in real life, where workers are oscillating between the fear of missing out and the fear of going back in and wrestling with the uncertainty of how life will look in the future, the investment dilemma seems to mirror this. This slide shows you a survey of fund managers, and it shows you that the levels of cash are the highest that they've been in some time. A recent FT survey confirmed also that many wealth managers took advantage, though, of the disruption in markets to reposition portfolios. 71% of the UK-based wealth managers polled on behalf of the FT say their clients bought after the markets plunged, although the wealth managers themselves do appear to be more cautious than their clients. However, the same source pointed out that only 4% predicted that markets would return to their pre-COVID highs. So where do we go from here? Those of us who've been around for a while remember that the last time this happened with such a narrow market was before the dot-com bubble burst, and sense the danger that this sort of market presents. So how should we be virus-proofing portfolios if it, as seems likely, will take some years for the global economy to return to some semblance of normality? And given that it is probably too early to assess what the long-term societal and economic consequences will be, I suspect that resilience rather than patience will be an investment virtue, as the roller coaster ride is unlikely to be over just yet. As the corona bounce peters out, and with the threat of new lockdowns around the world looming, it seems in our lives and our investments we should be aiming for some sort of new normal while making sure that we're prepared for the just in case. Looking forward, the key economic risks remain that investors are affected by a second round of COVID-19 infections that cause more lockdowns and permanent economic scarring. My crystal ball is as murky as everyone else's. There will certainly be many changed working arrangements and spending patterns. However, memories can be short. So while we are driving with our vision impaired, going slowly through the fog, just as in real life, I think it is important to maintain appropriate levels of caution in investments. Masks are definitely required, and investors will need sufficient protection to shield them from further bumps in the road. So where does an investor find true diversification from assets that are not correlated with each other but still have the potential to grow? Cash, for example, has very little benefit as it has zero potential to growth. The slide you can see in front of you shows you the expected returns, and this has been collected from 18 contributors, and also the correlations. High quality private equity and real estate can give a diversified allocation and act as a stabilizer and a return generator, but only for those investors, of course, who can sacrifice liquidity. There are also perhaps less obvious opportunities within equities to achieve diversification. Economists are suggesting that there may be advantage in looking east, where superior growth prospects and low correlations could increase return and reduce overall risk. Chinese equities, for example, as you can see on the chart in front of you, despite this year's outperformance, are still only at 15 times forward earnings and demonstrates an almost zero correlation to the US and European markets. It's probably true to say as well that most portfolios have relatively little allocated to the region. As the global economy reorients business and supply chains across two distinct centers of gravity, strategic exposure to both poles of the new G2, as it's being called, the US and China, will grow more important for diversified global investors in the years to come. In addition to growth-sensitive regions, at the heart of the post-COVID investment strategy is seeking attractively valued investments with resilient business models. The opportunities linked to digitalization, new ways of working, aging populations, sustainable food sources, and sustainable food production, to name a few, are likely to continue. The post-COVID lens, however, focuses not just on value, growth prospects, and resilience, but also on sustainability. In a world of high debt, low nominal growth, and low inflation, the priorities in investments as well as in life have changed. COVID has indeed accelerated many trends and reversed others, and has caused much distress. The silver lining may prove to be that the convergence of investing for good and good investing is happening faster than many of us thought possible, giving those of us who are stewards of capital the opportunity to future-proof portfolios and future-proof the world we live in. If we are indeed experiencing a once-in-a-100-year reshuffling of the way the world works, as Ray Dalio put it recently, then we would be well advised to reevaluate our investments, asking ourselves how the crisis and the new world order has changed our minds and about the prospects for the investments that we own. The World Economic Forum is referring to this as the Great Reset. If there is no longer a trade-off between societal, environmental, and financial wellness, and if they are all inextricably linked, perhaps we do have an opportunity to save ourselves, our wealth, and our planet at the same time. Perhaps this will prove to be the great legacy of COVID-19. Thank you for your attention. I hope you enjoy what I'm sure will be a range of stimulating debates and presentations, and stay well.